Real estate investors enjoy significant tax breaks that can enhance profitability and reduce overall tax liability. Below is a comprehensive list of the top tax breaks available to real estate investors, along with detailed examples for each. Depreciation allows investors to deduct the cost of a property's structure, not the land, over 27.5 years for residential properties and 39 years for commercial properties. Example: property purchase price, $300,000. Land value, $60,000. Depreciable value, $240,000. Annual depreciation, deduction, $240,000 divided by 27.5 equals $8,727 per year. Benefit reduces taxable income without requiring cash outflow. Deduct the interest paid on loans used to finance investment properties. Example: loan amount, $250,000. Annual interest paid, $10,000. Deductible amount, $10,000. Benefit: substantial savings for leveraged properties. Deduct the cost of property taxes paid on investment properties. Example: annual property taxes, $5,000. Deductible amount, $5,000. Benefit: directly reduces taxable income. Deduct ordinary and necessary expenses related to managing and maintaining the property. Examples of deductible expenses include property management fees at $3,000 per year, repairs at $1,500 per year, and utilities at $2,000 per year. That brings the total deduction to $6,500. The benefit here is that it encourages reinvestment in property upkeep. Deduct the full cost of repairs made to keep the property in good condition, though this does not include improvements. For example, if you replace a broken water heater for $1,200, the deductible amount is $1,200. The benefit is immediate tax savings for out-of-pocket repair expenses. Deduct travel costs related to managing your properties, including mileage, lodging, and meals. For instance, if you drive 1,000 miles per year at 65.5 cents per mile, that results in a $655 deduction. Additionally, out-of-town property visits might cost $500 for lodging and $200 for meals, totaling a $700 deduction. Altogether, your total travel deduction would be $1,355. The benefit here is that it reduces costs for managing distant properties. You can deduct fees paid to attorneys, accountants, realtors, and property managers. For example, accountant fees might total $1,200, realtor fees for leasing could be around $2,000, and legal fees might come to $800. In total, these deductions could add up to $4,000. This benefit reduces the cost of professional services. If you run your real estate business from home, you can deduct a portion of your home expenses. For instance, if your home office space is 200 square feet in a 2,000 square foot home, that's 10% of your home. With annual home expenses like mortgage interest and utilities being $20,000, the deductible amount would be 10% of that, which is $2,000. This benefit directly reduces taxable income for those managing properties from home. You can defer capital gains taxes by reinvesting profits from the sale of a property into a like-kind property. For example, if you sell a property for $400,000, with the original purchase price being $300,000, you have a gain of $100,000. By reinvesting the entire $400,000 into a new property, you defer the capital gains taxes on that $100,000 gain. This benefit allows investors to grow their portfolio without an immediate tax hit. You can offset passive income, like rental income, with passive losses, such as depreciation and operating costs. If you're an active participant, you may also deduct up to $25,000 in losses against other income. For example, If you have total passive losses of $30,000 and total passive income of $20,000, your deductible losses would be $20,000, which offsets all your rental income. This benefit, well, it reduces your overall tax liability. If you live in a property for 2 out of the last 5 years, you can exclude up to $250,000 or $500,000 for married couples of capital gains when selling. For instance, if you purchased a property for $300,000 and later sold it for $500,000, the gain of $200,000 would be excluded from taxes if you meet the requirements. This provides significant tax savings for house hackers. Deduct the full cost of qualifying assets, for example, appliances or HVAC systems, in the year they are placed into service. Let's look at an example. Purchase new appliances for $5,000. The deductible amount is $5,000, meaning you get a full deduction in the first year. The benefit here is immediate savings for capital investments. Receive tax credits for installing energy-efficient systems like solar panels or energy-efficient windows. To illustrate, consider a solar panel installation costing $20,000. The tax credit would be 30%, which amounts to $6,000. This benefit reduces your tax liability while also lowering operating costs. Scenario 1. Rental property tax breaks. Purchase price of $300,000 with a rental income of $24,000 per year. Expenses include property taxes at $3,000, insurance at $1,200, maintenance at $1,500, mortgage interest at $8,000, and depreciation at $8,727 per year. The taxable income is calculated as $24,000 minus the sum of $3,000, $1,200, $1,500, $8,000, and $8,727, resulting in $1,573. Without tax breaks, the taxable income would have been $24,000. Scenario 2, fix and flip property. Purchase price of $200,000 with rehab costs of $50,000. The selling price is $300,000 with selling costs of $15,000. The profit before tax is $300,000 minus the sum of $200,000, $50,000, and $15,000, resulting in $35,000. By using a 1031 exchange, you can defer taxes by reinvesting the $35,000 into another property. Tax breaks are one of the biggest advantages of real estate investing. By strategically leveraging deductions, depreciation, and credits, you can significantly enhance your returns and accelerate wealth building. Would you like help with specific tax strategies or further examples tailored to your portfolio?